Hi everyone. So today in this lecture we are going to start with a new area called as currency options and currency futures, including special forex concepts. So what is that much a special forex concept? We are going to learn money market hedging. Okay, that concept also we will learn. So in this there will be two areas which we are going to learn. Okay, area number one will be currency options, next one is a currency futures. Okay, and next one is a money market hedging. How many areas are there? Three areas totally. Currency options, currency futures and money market hedging generally will come in examination for 8 marks. This chapter will be accounting for 8 marks in examination. Generally in every attempt, derivatives come currency options, derivatives come currency futures will be tested in the examination. So these are two chapters actually, currency options, currency futures. So I merged all these things into one single area. All the past exam questions and RTP questions I kept in the material. So once you solve these questions now, you will be able to solve any kind of question that comes in examination with regard to the currency options and currency futures. Okay, let us start. Currency options and currency futures. So what is the idea behind this? Just 5 minutes basic introduction. Once completed, directly we can jump into the problem number 1. Okay, problem number 1. First let me explain the idea. See here, whenever we are exporters, we will receive foreign currency. Whenever we are importers, we will pay in foreign currency. When I am an exporter, my risk is fall in prices. When I am an importer, my risk is hike in the prices. Hike in the prices of what? Hike in the prices of foreign currency. So the problem is, since there is a element of risk, either rise in prices or fall in prices, there should be some strategy to hedge my foreign exchange risk. That exposure risk management itself we call as a hedging. How to hedge a transaction? You can hedge using forwards, you can hedge using money market hedging, you can hedge using leading, you can hedge using lagging, you can hedge using exposure netting, means debt or credit or balances netting, and you can use currency options, you can use currency futures. How many hedging strategies are there? 7 hedging strategies are there. Forward we completed, leading we completed, lagging we completed, exposure netting we completed. What is not completed? Money market hedging, currency options, currency futures. In this chapter, if we complete this, entire forex also will be completed. This is a derivative mixed with forex, dangerous area. Okay, so now whenever I am an exporter, my risk is the fall in prices. Whenever I am an importer, my risk is the hike in prices. To cover myself, I will go by a forward rate. I will go by what rate, sir? Forward rate. Instead of going by forward, we are having an alternative called as currency options and currency futures. In this, first let us start with currency options. Once completed the currency options, then let us go into the next area called as currency futures. Once currency options is understood, currency futures also we will do. Okay, easy to understand. We will first to do three problems in currency options. Next we will do 2 problems in currency futures. Later mix both of them and we will do. Okay, all kinds of problems we will be solving. Okay, 10 exam questions I have taken. 10 exam questions. Some came for 4 marks, some came for 6 marks, some came for 8 marks, some came for 12 marks also. All the questions are exam questions. Take study material, numbers also same. All questions I kept in the material. Okay, let us solve. Dead easy, Your perception of the concept will change by the time we complete this area. Totally 2.5 hours to 3 hours it will take to complete this. We will complete fully. Okay, it will be over. Let us start one by one. First, I will be targeting first on currency options. Okay, see here. Whenever you have a import exposure, the risk is hike in prices. The risk is hike in prices. Why? Because you have to buy the dollar in the future. At that time, dollar rate may be anything. Whenever you are making an export, the risk is a fall in prices because you have to sell the dollar. Sir, whenever I use the word dollar, foreign exchange or foreign currency, instead of using that, I will use the word dollar. Dollar means foreign exchange or foreign currency in my terms. Whenever you are an importer, you have to buy foreign currency. Whenever you are an exporter, you have to sell foreign currency. When you are an importer, the risk is a rise in prices. When you are an importer, risk is the rise in prices. When you are an exporter, risk is the fall in prices. For covering ourselves from the risk, we will enter into a forward contract. We will enter into what contracts are? Forward contract. Okay. However, forward contract is to some extent disadvantageous. Do you know why? See here. $1 equal to rupees 80. $1 equal to rupees 80. This is forward rate quoted by the bank. Now I have given $1 equal to rupees 80 option. Which option? You have to buy in a call option. On the dollar, I will give you a call option. On what, sir? On the dollar, I will give you a call option. Okay, how to do this? $1 equal to 80. Forward rate is quoted by the banker. $1 equal to 80. Option is also traded on the dollar. You will go for the first one or you will go for the second one? Obviously, your answer is you will go for the second one only. Do you know why? I will tell you why. This is mandatory buy. This is optional buy. Means what? On the date of expiry or on the due date, if really the dollar price came to 74, even at that time, I am forced to buy at 80 in case of bankers forward. However, if I take an option in the market, if it is getting traded at 74, I will lapse the option and I will purchase in the market. So, therefore, the options sometimes seems to be perfect than forward. Sir, why, sir? Always options are better, na? No, premium element is there. For example, on this 4 rupee premium is there. Means what is your net cost? 84. Therefore, forward till it reaches 84, it is always better than options. On this only, first 3 problems are tested. One fantastic question they asked in exam. Similar question also asked in another exam. What is that? That's the question number 1. If you do that and experience, then only you will really understand the meaning of currency options. 6 marks question came in exam. Sorry, what is this? Okay. I think study material open. Okay. See here now. A German firm buys a call on $10 lakh with a strike of DM $1 equal to 1.6 DMs and a premium of $1 equal to DM 0.03. Opportunity cost is 6% per annum. Maturity days is 180 days. What is the break-even maturity spot price beyond which the firm makes a net gain? Suppose the 6 months forward rate at the time the option was bought is $1 equal to DM 1.62. What is the range of maturity spot rate for which option would prove to be better than forward? For what range of values forward cover could be better? This is the question. First, read the question properly before we go with the solution. First, read the question properly, everyone. I'm putting the screen before you. Read the question properly before we start. Hope you understood what we are asking now. We are not doing currency futures first. We are doing a problem on currency options. So, indifference between forward and options is the first type of model of questions he will ask in exam. Okay, read it. Read the question. Now see here, I've given you 2 minutes time exactly to read the question. Okay, hope you read the question. Let us do the solution now. A German firm buys a call. It has to make a payment in dollars. So $1 equal to DM 1.6, premium $1 equal to DM 0.03. Why interest cost is given, I will explain. Okay, and maturity is 180 days. What is the break even spot price? Okay, what is the break even in options? We already completed in options chapter. What is the break even? SP plus P. SP plus P. So first let us try to understand what is the total DM outflow. Okay, so he is asking which is better, forward or options. Keep the heading currency options and currency futures. Question number 1. Question number 1. Okay, first step 1. Calculation of break even price for dollar call. Offer a dollar call. Tell me, what is the strike price? Strike price equal to, we are German firm na, for our point of view we need to write $1 equal to DM 1.60. What is the premium? Premium equal to 0.03. Okay, now first break even price for calls equal to SP plus, SP is a price you will pay today na, you will pay in a future date, at a future date you will pay, not today. Means technically we have to add future value of premium. I told you this point very clearly if you remember when we are doing options chapter. So why we calculate the future value of premium means SP is paid in the future, for which you can't calculate the premium which you will pay today. Even this point I said in the options chapter very clearly on that day. What I said, since in the question they don't give any kind of interest rate, we take premium as a premium, or else we have to really take future value of premium because SP is paid in the future. Okay, let us take. SP DM 1.6 plus future value of premium. So premium is how much? 0.03 into e power 180 by 360 into what is the rate? 0.06. So DM 1.60 plus 0.03 into e power 180 divided by 360 into 0.06 e power 0.03. So DM 1.60 plus 0.03 into 1.0305, 0.0309. 4 digits we need to take in forex na. So therefore DM 1.6309 is the break even point for dollar call option. Simply this is the net cost. This is the net cost. Net cost means what? At that cost you need to buy. That means if you want to buy a dollar option, you need to pay SP on due date plus premium. Okay, plus premium. Now let us understand what he asked. First question, what is the break even price? Okay, this is the break even price. Over. First point over. Suppose the 6 months forward contract is trading at 1.62. Okay, at what range of maturity spot rate option would be better than forward and forward would be better than option? Okay, so this is what he is asking. How to do this is the next challenge. So let us do the concept clearly in detail. I will explain step by step how to do, but prima facie I will explain one point. How much is the cost of forward? 1.62 DM. What is the cost of option? 1.6309. 1.6309. 1.6309 is the SP. In the market, if the dollar has come to DM 1.61, then what you will do? You will lapse and buy in the market instead of going for a forward. Yes or no? So now we are going to understand that particular area. Okay, let us make a full analysis. If you do one problem, then only you can really appreciate the logic behind. Okay, keep the heading step 2. Step 2. Comparison between options and forward. Comparison between options and forward. Okay, let's do. Okay, see here now how to make a comparison. How to make what's a comparison? Let us try to understand. I will first write a schedule. Okay, after that I will ask you to copy. At the time, please copy down. At the time of discussion, please don't copy anything. First, SP, AP, action by call holder. Action by call holder. Action by call holder. Outflow, future value of premium, total outflow, forward outflow, remarks. Okay, remarks. SP, AP, action by call holder, outflow, future value of premium, total outflow, forward outflow, remarks. I am erasing the first column. Just for rough sake I have written that. Okay. Now everyone look into the point. First, how to understand? Okay. See here. First situation. Okay, see here. First point, follow the procedure properly. It's a reverse procedure. First one, indifferent. What is that? Indifferent. When indifferent situation will come, what is the forward outflow? DM 1.62 given in the question. Forward DM 1.62 he has given, he has given here. Okay, now DM 1.62, that's a forward rate. Next, what is the total outflow? If the total outflow under the option is also DM 1.62, then whether to go by options or whether to go by forward, both will be indifferent. In the options, if you should have 1.62 outflow, okay, in the options route, if you need 1.62 outflow, this should be after payment of premium. What is the future value of the premium? DM 0.0309. Already we calculated, na? That means what should be the strike price, what should be the options original outflow? 1.62 minus 0.0309 means it should be 1.5891. It should be 1.5891. If it is 1.5891, what is the SP? SP is 1.6. What is that? 1.6. 1.60. 1.60. What is the actual? 1.5891. If actually is 1.5891, okay, SP is greater than AP, I am buying it. In the market, it is available at 1.5891. Why I will exercise? I will lapse. I will what's a lapse? So what you have to understand, in order to make option as indifferent with the forward, you should first lapse the option. Okay, means if the actual price in the market is 1.5891, if the option, if the market value is 1.5891, then you will lapse the option and you will buy in the market at 1.5891. Already you have paid the premium 0.03, future value becomes 0.0309, total full put together will become 1.62. Total put together will become 1.62. Okay, now you will get a doubt. I will clarify every doubt. Okay, first understand the transaction, what has happened. So how to understand this? Maybe now you may get a doubt. Sir, you are writing here option cash flow. Okay, in this block you have written option outflow. How it become option outflow, sir? You are exercising a lapsing. When you lapse, why it become option outflow? It becomes the outflow from the market you are doing. Wrong interpretation. Did you understand the wrong that you committed? If you understand like that, shall I tell you one point? See here. What is the forward rate? 1.62 DM. Say for example, you don't have an option. You don't have an option at all. You entered into a banker's forward. Whether the price comes to 1.58, whether the price goes to 1.70, you are now locked to buy only at how much? 1.62. Now, because of having a option in your hand, you are having a chance to lapse it and try to buy in the market at a lower price. That means the concept of lapsing has come because of forward, because of options. Therefore, we will consider this flow of outflow as an option outflow only, because really if you would have exercised that, your cost will be 1.6309. Because you lapsed, the cost is lower here. Okay, so when you want a indifferent situation, outflow under the forward and outflow under the options, both should be same. To have a both outflow to be same, you should also consider the option premium. When you are considering the option premium, you should consider the future value of the premium. That's what we have done here. Clear, everyone in the class? So next, let's continue. Okay, so let's continue. Next, I want to make option as selective option. Means option should be selected. Then when your option will be selected, forward is 1.6200. Forward is 1.6200. Whenever 1.62 means 1.6200. 4 digits we need to take now, we have taken. So if the forward outflow is 1.6200 and if the option outflow is DM 1.6199, okay, at least one last digit less, then I will go for option instead of the forward, because in bulk that 0.0001 will make a difference to me. So 4 digits we need to consider. 1.6299, 1.6200 is the forward cost. If the outflow from the options is 1.6199, I will go for the options rather than going for the forward. Okay, and now DM 0.0309 means after paying this it should be 1.6199, means 1.6199 minus 0.0309 means how much? It should be 1.5890. Outflow 1.5890 means it is not 1.6, means you are not buying at spot, means what it will be 1.5890, the actual price. What is the strike price? 1.60. You will exercise a lapse and purchase at how much? 1.5890. Lapse and purchase at 1.5890. Paying the future value of the premium will be there. Net cost will be 1.6199. Even after the payment of premium, option A is lesser than the forward, then the option will be preferred. No sir, now I want forward preference. Okay, forward preference means how to understand? Same, DM 1.6200. If this is DM 1.6201, then what is better? Forward is better. So this should be after DM 0.0309. So 1.6201 minus 0.0309 means you should have spent 1.5892, means 1.5892 is the actual one. 1.60 you would have lapsed. Okay, that's why in the options chapter I said very clearly, okay, people will enter into the options market not to exercise but to the lapse. This is a classic example. Okay, this is what he asked the question. Reverse calculation you need to understand. Okay, copy the problem now. Hope everyone understood how to do the options. Completed? So hope you completed the answer. Hope you completed the answer, everyone. Okay. Okay. Now let us try to understand the next problem. Just a minute. Yes. Okay. See here. Now we have done problem on outflow. Let us do one problem also on inflow and get the clarity. A French exporter to UK has 90 days sterling receivable. He purchases a put option of pounds 2,50,000 at a strike price of French francs 8.0550 for pound at a premium of French franc zero point 0.2 per pound. The current spot rate 1 pound equal to French franc 8.1. 90-day forward rate is 1 pound equal to French franc 8.0750. The interest opportunity cost is 9% per annum. Calculate the maximum FFR by pound rate at the end of 90 days below which the firm will make a net gain from the put. Calculate the range of maturity spot over which the option would be better than forward and vice versa. Read the question before we go with the solution. Everyone please read the question first. Before we move on with the solution, read the question first. Read the question properly. Completed? Okay. Let's now take the question. Let us try to solve the answer as well. See here, in this case, there is an exporter. He is a exporter. How much is the receipt? Pounds 2,50,000. Risk is hike in price or fall in price or fall in price. Therefore, I want a guaranteed selling price. Therefore, I want to enter into which contract? A put contract. I entered into a put. Purchase as a put means a put holder. Okay, strike price 1 pound equal to French franc 8.0550. First, let us understand the break even value or net value. Question number 2. Step 1. Calculation of break even actual price for put. Write down. SP minus future value of premium, that equal to SP. SP is 8.0550. 8.0550 minus future value of premium. What is the premium amount? 0.20. 0.20. Okay. So what is the rate of interest that was getting traded now? 9%. How many days? 90 days. So into e power 3 by 12, 90 days means 3 by 12 into 0.09. So French franc, do along with me. 8.0550 minus 0.2 into e power 3 into 0.09 divided by 12. 0.0225, that equal to, okay, FF 0550 minus 0.20 into, do the calculation everyone. Okay na? So the answer is 1.0228. So FF 8.0550 minus 0.2 into 1.0228. Okay, 0.2045. So totally 8.055 minus 0.2045 means 7.8505. 7.8505. 7.8505. Okay, copy down up to here. What is this 7.8505? This is the net value that you can get. Okay, minimum this value you need to sell. SP is the selling price, premium is a payment you make. So net selling price is, net inflow is 7.8505. Okay, done up to here everyone. Take another 1 minute time please. Copy down fast. Once you complete, we go to the analysis. Schedule we will first do. Once the schedule is done, we will copy the answer. Shall we continue? Let's. Step 2. Step 2. Option versus forward. Same schedule, sir. But this time outflow will not be there, inflow will be there. That's all. Write down. SP, AP, AP, action by put holder, action by put holder, inflow, future value of premium, net inflow because of option, net inflow because of forward, and lastly the remarks. First, I want indifference point, means receipt in the forward. What is the forward rate? The forward rate is 8.0750. Net inflow. Options also, if the net inflow is 8.0750, indifference will come. What is the future value of premium? 0.2045. 0.20, then 0.2045 means net inflow. That means I will get some inflow here, which minus this has to give this. Okay, that means net inflow should be added by this particular amount, 8.0750 plus 0.0. If the inflow is 8.2795, okay, and premium once you deduct, the net inflow is 8.075. Indifference means, what is the strike price? Already we know. What is the strike price? 8.0550. 8.0550. 8.0550. Okay, so these are the three rates. You have paid 8.0550 na? No, you paid 8.27, means higher than that. Means in the market it would have been traded at 8.9725. When you have a chance to sell in the market at 8.2795, why you will like a fool sell at a lower price of 8.0550? So you will lapse and you will sell in the 8 point. But however, you already paid a premium, so net inflow has came to 8.075, which is almost indifferent with the forward. Okay, remarks is indifference point. Remarks is indifference point. Next, second situation, I want option to be better, means 8.0750 means 8.0751 it should be. So future value of premium, this one. So calculate 8.0751 plus 0.2045. 8.2796. 8.2796. Okay. So 8.2796 you will lapse. Next, I want forward to be better. Means 8.0750, 8.0749. Okay. So 0.2045, 8.0749 plus 0.2045, 8.2794, 8.2794. Okay, even in this case 8.2794 I will lapse. Reverse calculation you have to do. Okay, so please solve this. Copy down. Hope everyone understood and then only you are doing. Hope you are doing by understanding it. Completed? Now. So hope you completed understanding this concept as well. So this is how the first problem and second problem has to be done. Next, third one. Your company has 12-month payable of DM 1 lakh and the current rupee by DM spot is rupees 20. The rupee interest rate is 21% per annum. The DM interest rate is 10% per annum. To confuse you, both the rates are given. You are considering a forward hedge at the current forward rate of 22. An executive of another company tells you that he recently bought a call on DM 1 lakh at a strike price of rupees 20 and is willing to sell it to you at historic premium of, not means normal premium of rupees 1 per DM or rupees 1 lakh for the entire contract. The call matures at the same time as your payable and is a European call. What should you do? Read the question carefully. 4 marks question given in exam. It's a 4 marks question given in exam. Read the question properly before we start with the solution. Okay, so let's start with the solution now. We are having two options now. Small question only. We have to do how much outflow you will have if you go by a forward. You should also do how much outflow you will have if you go by a options. Okay, question number 3. Okay, right on. Outflow due to forward. So first tell me how much is the invoice DM 1 lakh. In how many months? 12 months I need to pay. DM 1 lakh. Okay. Next, if you pay in the forward la 1 DM equal to how many rupees? Spot rate is 20. I logged myself at 22. So net outflow will be rupees 22 lakhs. Rupees 22 lakhs. Next, number 2. Outflow due to call option. Outflow due to call option. Okay, let's do number 1. What is the future value of premium? Rupees 1 into e power 0.21. 0.21 e power, please calculate everyone. Rupees 1 into 1.235. Rupees 1.235. Rupees 1.235. Okay, this is the amount that we need to spend on premium. Number 2. What is the strike price per DM? Rupees 20. Strike price is rupees 20. He has given in the question 20. Rupees 20. So net cost per DM equal to rupees 21.235. So total outflow due to option equal to 1 lakh invoice into 21.235 means how much? Rupees 21 lakh 23,500. If you make the payment using the forward, you need to make 22 lakhs. If you make using the options, it is 21,000. Therefore, options is recommended. Obviously, when you are doing questions on options, options should be made as a hero, or else then why you are doing options chapter? So currency option will be the hero. So with this, we have completed third question as well. These are, first question came for 6 marks, second question came for 5, this came for 4. Now one type of questions we completed. Let us now move on to the second type of questions. Before that, let us first also complete the concept of futures. What is that? Futures. Okay. Now currency options la basics we completed. Not basics, questions are advanced questions only. Not really great difficult questions we didn't enter. We will enter. So let us also solve question number 4. On January 5th, an Indian firm imported goods from US firm for consideration of $4 lakh payable on 15th February. The spot exchange rate is $1 equal to rupees 44 and the March dollars futures is traded at $1 equal to rupees 45. Suggest a strategy to the Indian firm to hedge its payable exposure. On 15th February, if the exchange rate in the cash market drops to $1 equal to rupees 39, on the same date March futures is trading at $1 equal to 41, calculate the hedge efficiency for computation. Assume futures contract size to be $75,000. This is the question that he asked. Okay, please read the question properly before we go with a solution. Please read the question properly. Take 2 minutes time, no problem, but read the question properly. We are now going into next area called as a futures hedging. Okay, we completed options, we are going to futures later. Once after you do the fourth problem now, from fifth problem onwards, advanced issues will come. Once you do those exam questions, easily you can solve. Okay, please. So hope everyone completed reading the question. So hope you completed reading the question, everyone. Okay, let us now go into the understanding and solution part. Nothing great even in this question. Same concept, whether to go by forward hedging or whether to go by options hedging, whether to go by a futures, it is depending on your strategy, whatever you want to take it. But how the answer has to be done in the exam is a query now. Listen carefully. We are having a importer in the question. Okay, importer is what the taken. Importer will receive currency, will pay currency, I mean will receive foreign exchange, will receive foreign currency, will pay in foreign currency, he will pay in foreign currency. Means he want a guaranteed buying price, a guaranteed selling price, a guaranteed buying. That buying has to be done today na, in future, in future. Therefore go in the futures with a futures buy. Futures you need to take a futures buy. This is first strategy number one. How it works practical I will show with the numbers in this question, but first believe me how to do the problem. Okay, I repeat, we are importers, exporters, importers. Listen to my language. Okay, why I always explain like a small kid, why I will always explain like that, you repeat along with me, then you will remember the concept. Okay, repetition once again. We are exporters, importers, importers. Importer is a person who will receive foreign currency, pay foreign currency, pay foreign currency. Means we have to buy dollar, sell dollar, buy dollar. Buy dollar is risky or not risky? Risky because we are not buying today. We are buying when we are buying in the future date. So when we are doing something in the future, future is always turbulent and future is always shaky. We don't know what will happen in the future. So therefore, since we don't know what happens in the future, future is always a risky task. Therefore, we enter into hedging. Okay, one is a forward hedging. We just lock ourselves to a forward and complete. Second one is another hedging strategy, money market hedging. After this problem, I will discuss about that. So money market hedging. And third one is the futures hedging. Third one is what hedging, sir? Futures hedging. So futures hedging is the third type. Futures hedging, how to do? You are an importer, means you want a buying, a selling, a buying of rupee, a dollar. So therefore into the market you go, you enter into a forward buy, because we want a buy contract na. We want to have a we want to have a guaranteed buying price in future. So in the futures you give a buy contract. When you give a buy contract in the futures, really you will buy, you will not buy, you will not buy, you will take a counter sell. You will take what sell, sir? Counter sell. Okay. Now let us do the problem in detail. Now he is asking us, if you go by a forward, if you go by what, sir? Forward. If you see spot exchange rate is 44. Okay. Dollar futures is trading at 45. Dollar futures is trading at 45. On 15th February, exchange rate in the cash market drops to 39. Okay. Futures is dropped to 41. Calculate hedge efficiency. Standardized lot size is $75,000. Okay. This is the question that is being asked. Okay. First, let us do the question. Keep the heading. Question number 4. Step 1. Calculation of number of contracts. Calculation of number of contracts means how many contracts I need to trade. First I need to have a clarity on the number of contracts to be traded. Okay. See here now. How many contracts I need to trade? First, number A. Tell me, what is the invoice value? Invoice value is $4 lakh. What position we are having? Buy futures. Next, what is the futures price? Rupees 45. $1 equal to rupees 45. Understood up to here? So $4 lakh is the total thing, and $1 equal to rupees 45. March futures trading at rupees 45. Okay. So up to here, hope you understood the logic clearly, right? So let's go into the next. Okay. Next one. Standardized lot size. $75,000. So number of contracts equal to 4 lakh dollar divided by $75,000. 4 lakh divided by 75,000, 5.33 rounded off to 5 contracts. Rounded off to 5 contracts. Hope up to here you understood the logic, right? This is a number of contracts. Next, number 2. Okay. Number 2. Position on maturity date. Position on maturity date. Instead of writing like that, we will do one thing. When I need to make the payment, 15th February. When I need to make the 15th February. Position on 15th February. Okay. First, everyone answer my question. I need to pay to whom? I need to pay to my exporter in USA. I am an importer, exporter. I am an importer. I need to pay to whom? Exporter. Exporter is in India, outside India, outside India. So to that exporter outside India, I need to make a payment. I need to make what, sir? Payment. Okay. To whom? To an exporter outside India, I need to make a payment. Okay. So I am an importer, exporter, importer. Now listen carefully. If I take a position in futures, futures there is a physical delivery of securities and dollars, only net settlement. As an importer, I need to really pay them. Therefore, whenever I tell futures, first you need to take 2 positions. How many positions? 2 positions. One is cash market, another one is futures market. Okay. See here now. Cash market means what? Since I am using the futures market as a hedging, I will open my exposure uncovered. Okay, I will open my exposure uncovered. What I will do now? What I will do is directly I will pay in the cash market. In the cash market, the price dropped to how much? $1 equal to rupees 39. Rupees 39. So $4 lakh equal to how much? 4 lakh into 39. So rupees 1 crore 56 lakhs. Okay. Now, futures market lo what will happen? I have taken a buy position. I have taken a buy position. Buy position at how much? Rupees 45. Now I will really buy it, take a counter sell, counter sell. On maturity date, convergence will be there. What will be there? Convergence. Convergence means at what price? Sorry, one second. Sorry. Here, if you observe clearly, this particular January 5th payable on 15th February. Okay, payable on 15th February. March futures are trading at 41. Okay, why March futures are at 41? Why it is not 39? Due to one reason. They opened this contract on January 5th. Real expiry in the market may be March 15th. I am coming on before maturity date on 15th February. Therefore, I should give a rate prevailing on that day. When convergence will be there? Convergence will be there if I am there on the maturity date of the exchange. But I am not there till the maturity because it is a March futures. Means what? It ends on 15th March. But I am coming on 15th March or 15th February. 15th February. Means I need to give at a, okay, I need to give it a prevailing exchange rate. Okay. Now rupees 41. Hope you understood what I said here. Repetition once again. Clarity should be there only in this. I entered into which contract? March futures contract, expiring in the month of March. But I want to really make the payment in March or February. I can come before maturity date or not? Yes. At the prevailing rate. At that time prevailing rate is 41. Okay. Buy at 45, sell at 41, loss again, futures line incurred loss. How much? 4. Number of contracts? 5. Number of dollars per contract? 75,000. So what is the total loss? 75,000 into 5 into 4. Rupees 15 lakhs. Rupees 15 lakhs. So how much is the net realization? This is the loss and this is the total outflow. So 1 crore 56 lakh minus 15 lakhs. So net what I will receive? Rupees 1 crore 41 lakhs. Rupees 1 crore 41 lakhs. Means for 4 lakh dollars I have paid 1 crore 41 lakhs. Okay. One second. I'm very sorry. 1 crore 56 lakhs is the payment. Okay. Total loss is also a payment to me. This is also payment. Okay. Let's add both of them. That's why. So 1 crore 56 lakhs is an outflow. Plus there is another outflow of 15 lakhs. So totally 1 crore 71 lakhs. 1 crore 71 lakhs. Sorry. I thought that this is inflow. 1 crore 56, we are importers, we need to make the payment. So whenever you enter into futures market la net settlement will be there. Really there will be no delivery of dollars, but to the importer I need to pay. You will enter into normal market. So you waited, it is 1 crore 56 lakh, but already you entered into a futures contract which you can't deny. Okay, on that you incurred a loss of 15 lakhs. So totally you end up with a total net outflow of 1 crore 71 lakhs. So 1 crore 71 lakhs divided by 4 lakh dollar, it is a 42.75. So net how much you cost? 42.75 you spent. Am I clear everyone? So this is the point. Please copy down. Completed? Okay. See here, he asked everything okay. Lastly, he asked us to calculate the hedge efficiency. What efficiency, sir? Hedge efficiency. What is the concept of hedge efficiency? See there, if I would have paid in the spot, I will erase this. See the question. If I would have paid in the spot, at what rate I would have paid? $1 equal to rupees 44. Okay, because of entering into the futures contract, I literally opened my cash market exposure uncovered. Means I would have paid at 44. Okay, I will write like this. Keep the heading hedge efficiency. Okay, hedge efficiency. Payment at spot. How much I would have paid? 4 lakhs into 44. I would have paid rupees 1 crore 76 lakhs if I would have paid at spot. Because of making a futures contract, and happily I am sleeping. Futures will anyway take care. So on the market side, because of the futures, payment due to futures hedging. Okay, payment due to futures hedging means in the cash market, because you hedged using futures, you kept your cash market uncovered. Because of that, you paid 4 lakhs into 39. Okay, 4 lakhs into 39 means how much you paid? Rupees 1 lakh 56,000. Rupees 1 lakh 56,000. How much you would have paid? 1 lakh 76. How much you paid? 1 lakh 56. Means how much gain you have made here? Rupees 20 lakh. Rupees 20 lakh. But what is the loss in futures? What is the loss in futures? Rupees 15 lakhs. Now that means how much is the hedge efficiency? Hedge efficiency equal to profit by loss into 100. Profit by loss into 100. What is the profit? 20 lakhs divided by loss 15 lakh into 100. 20 lakh divided by 15 lakh into 100. Hedge efficiency is 133.33%. Okay, so what is the meaning of this 133.33%? Listen carefully to the logic of the hedge efficiency before going into this. If I would not have a futures contract, I would have paid at the spot. I would have paid at the spot. If I would have paid at the spot, I would have paid 1 crore 76 lakhs. Just because that I have a mentally I am fixed, that psychologically I am satisfied that since futures is there I am protected, I opened my exposure uncovered in the cash market. Because of that I could take the advantage of the 39 rupees. If I would have entered into a forward contract, what would have happened? Even though in the market price falls to 39, I should have purchased only at that 43 or 44. That means how dearly you opened your cash market? Because I have a mental stability that in the futures anyway I am protected. That means if I am losing here, in the futures I will get the margin surplus. So here if I get a margin deficit, here I will be having a lesser amount of payment. So therefore the profit which you have got is the gain. Whatever you got is 20 lakh gain you have. Okay, when you see the loss of 15 lakh, you are seeing only futures have given me loss of 15 lakh. No, since you opened the futures contract, okay, since you are already covering your risk in futures market, you are daily opening your exposure without any hedging. Okay, that means this advantage of 39 you are availing because you are ready to bear the loss in futures. Okay, so therefore you can understand, still you are end up with a gain even in this case. Okay, hedge efficiency is 133.33%. okay, with this we have completed one model of currency options and currency futures. Okay, totally 10 problems we have completed. How many? 4 problems we have completed. Okay, so then next we will start with question number 5. question number 6, 7, 8, 9, 10. Okay, before even doing with any of these, keep the heading money market hedge or money market hedging is the next area. Once you complete money market hedging, we go into combination of a question will be asked for 10 marks, 8 marks, 12 marks. They will ask forward hedging, money market hedging, currency options, currency futures in the same question. At that time, how to do also we will see now. Okay, na? So let's go to the money market hedging. So let's continue. Let us go with problem number 10. So take question number 10. So we are going to start with an area called as money market hedging. What is the name of the area? Money market hedging means money market hedging is a hedging strategy using money market means what? Borrowing and deposit. We will use this as a base in order to hedge our risk. That's called as money market hedging. How this strategy will be useful? Let us try to understand using a problem. For that I have a question number 10. Let us read the question first before we start doing with the money market hedging as a solution. An Indian exporting firm, Rohit and Brothers, would be covering itself against likely depreciation of a pound sterling. Exporter, importer, export. Exporter will have a receipt, a payment, a receipt. Therefore, they are having a fear of a likely depreciation of the pound. They have to receive in the pounds. By the time they receive after how many months period? 3 months. By the time they receive it after 3 months, they are thinking that there will be a fall in pound prices. If there is a fall in pound prices, what will happen? Their receipt will reduce. In order to cover this risk, they are now entering into the market. So they will be obviously having two options. One, they can go for a forward hedging. Number two, they can go for a money market hedging. Now in this query, we have money market hedging as a base. Okay, what exporter would do? See here. Now first we need to understand how the exporter is going to use this information for money market hedging. Okay, for money market hedging. Receivables 5 lakh pounds, spot rate 1 pound equal to rupees 56, 3 months interest rate in India, UK. What exporters should do? Okay, below write down use MMH. That is also there. It was not printed here. They have only given in the question use MMH. Okay, this is the information that is being given. Based on this, we need to do the answer. First, read the facts once before we do with the solution. So read the question. Hello, 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 hello. So don't think otherwise, just I'm testing the mic. Some problem has come. Nothing more than that. Read the question. Problem, hello, hello, hello. Audible, huh? Ah. Hello, hello. Ah. Okay. Okay. So let us see now. So we are going to solve questions on money market hedging. So first listen carefully. The Indian exporting firm Rohit and Brothers would be cover itself against a likely depreciation of the pound sterling. The following data is given. Receivable 5 lakh pounds, spot rate 1 pound equal to rupees 56, payment date 3 months. 3 months interest rate, India 12%, UK 5% per annum. What should exporter do? Okay, listen carefully. First point, we are having receivables up, payable receivable exposure. Okay, now listen carefully. First write down the facts. Question number 10. Keep the heading question number 10. Okay, let's write down the facts. First, exposure, receivable payable receivable. Number 2, spot rate. $56. Number 3, amount 5 lakh pounds. Number 4, term 3 months. India USA 5% per annum. This is the information that is being given to us. Okay, from this information we need to do the hedging. We need to do what's our hedging. Which hedging we need to do? Money market hedging. Means we need to use interest rates as a base to hedge the foreign transaction. How it will be possible? Let me explain. First, you should only tell me I am having a receivable exposure, a payable exposure, a receivable exposure. Receivable today na after 3 months, after 3 months. That means receivable made after 3 months is risky for me, not risky. It is very very risky for me because after 3 months or 4 months, okay, or after 3 months, the dollar or the pound rate may even come to 52. So they said that there is a chance that the pound can depreciate in the near future. If the pound depreciate, what will happen? For 1 pound today you are getting 56 rupees. Pound depreciation, you will get only 54 or 52 or 51 or something like that. That means my rupee realization after 3 months may fall. Therefore the exporter want to take a position. The exporter want to take what's our position in such a way that there should be a hedging. Means I should not incur a loss. What is hedging? Hedging is not profit strategy. Hedging is a stop loss strategy. Lock yourself at a rate today itself. Yourself today itself. Once you lock yourself today itself, you know whatever is happening in the future today itself, risk is not there. Risk means what? Uncertainty. Okay, risk free strategy or risk reduction strategy means what? We are reducing the uncertainty to the least level. Using the money market hedging, you will reduce the risk to zero also. How it is done? Let's try to understand clearly. Okay, now tell me, when I am asking you the question as if I am asking in front of you, answer the questions. I am having a receivable, payable. I'm having receivable, payable. I'm having a receivable. After 3 months or today, after 3 months, risky or not risky? Very very risky, because it may fall. Okay, now when if it is received, no risk is there. If it is received when, risk is not there. If it is received today itself, risk is not there. Okay, if it is received today itself, risk is not there. So if it is received today itself, risk is not there because today rate I know 56. I will convert immediately 5 lakh into 56 I will get. But today I will receive after 3 months after 3 months. So money market hedging works on a strategy like this. What is not possible, make it possible. I repeat, what is not possible, make it possible, or make it possible practically. When if I receive, problem will not be there, uncertainty will not be there if I receive if I receive today, but my invoice is for 3 months. Therefore, the particular concept said that whenever you are having a receivable, okay, you have to do the following: borrow foreign currency today, borrow foreign currency today. Okay, how much I need to borrow? Borrow only present value of exposure. Present value of exposure means what? Like we have seen in put call parity theorem, na, PV of SP means it will mature to SP on due date. Like that, don't borrow entire 5 lakhs. Borrow present value of pounds 5 lakh. Okay, which matures to 5 lakh in 3 months. Why? Everything I will explain. Okay, first let us understand. Borrow. Okay, borrow. Deposit in home currency today. Okay, sir, why I have to do this? I will explain. See here. I will be doing this using a box approach. Okay, see here. How it will be done, let me explain with one problem. After that, we both can do the remaining. Okay, first problem na, I will do. I will give time for you to copy also. First listen. Methodology what we are going to follow now. Money market hedging la any one of you listening have a doubts previously, all doubts will be cleared. Okay, easily I will explain. Exam la money market hedging comes na, he will die. He will die in your hands. So easy method of understanding money market hedging, dead easy method. Okay, if you follow these 4 boxes approach, done. Any question can come in exam, you will be doing. Shall we? Let's start. Don't do, I will first do. Okay, always right hand side boxes are Indian boxes, left hand side is the US boxes. Here my intention UK. Here my intention is home currency on the right side, foreign currency on the left side. That's the meaning. Okay, first tell me what is the tenure. 3 months. Okay, and these are future value boxes, these are present value boxes. Like this, if you see future value, like this if you see present value, foreign currency, home currency. Okay, okay, see here. Okay, so values will be written here. Okay, currencies will be written here. What letter it formed? H, hedging. The brothers gather. So therefore that's the idea behind, but that is not the idea. Unfortunately, coincidentally it also became same. But main point I want to tell is 3 months after. Okay, this is the 3 months after future boxes. 3 months. 0 month means today. 0 month means today. Okay, let's start. So now, so UK, India, 3 months and 0 months today, technically. Okay, now listen carefully. I will be receiving the amount today na in future. In future means how many months? After 3 months. When risk will not be there if you receive today. When you will receive today, if you borrow today that many number of US dollars, okay, today you have to borrow that many. Tell me, I will ask you one question. We have a receivable, a payable, receivable. Okay, receivable in pounds. Okay, observe the boxes. You have a pound receivable. Which box I am writing? UK box la future value. How much you will receive? Pounds 5 lakh. Okay. Now my question is, in order to receive in pounds, you need to deposit in pounds. You need to withdraw in pounds. I repeat, in order to deposit, in order to make the total as a 5 lakh. That means you want to make total as a 5 lakh. Okay, so you are receiving in UK pounds, you are paying in UK pounds, you are paying in UK pounds. Sorry, you are receiving in UK pounds. Means your receivable will come today, na? Your receivable will come after 3 months. After 3 months, receivable will come. Okay. Now listen carefully to the point. I have a receivable. Okay, I have a receivable today, na? After 3 months. After 3 months. Means this is a asset or liability. This is a asset. This is a asset. I will write here. This is a, okay, I will write here asset. Okay, this is a asset. Now I need to create a counter liability for this. I need to create what's a counter liability for this. Okay. To create a counter liability, that liability should also be equal to 5 lakh. Why? I will tell you later. 5 lakh liability I need to create. To create a pound liability, I need to borrow in pounds. I need to deposit in pounds, borrow in pounds. Okay. So borrow, sorry, present value of pounds 5 lakh. Working I will do here. Pounds 5 lakh I will receive today, na? After 3 months, after 3 months. What is the interest rate in pounds? 5%. 5 into 3 by 12. 1.25% means 1.0125. So 5 lakh divided by 1.0125 means how much? 4 lakh 93,827 pounds. If I borrow 4,93,827 pounds today, that will mature to how much after 1 year? After 3 months, that will mature to 5 lakhs after 3 months. Okay, borrowing is a asset or liability? Liability. Liability created in rupees or pounds? Pounds. This liability of 5 lakh will be paid through the receipt after 3 months. Okay, so the liability and the asset will be knocking off each other. I am not caring about them. Sir, I didn't understand. Nothing I explained also. Okay, just I am putting numbers. How binomial model, risk neutralization model we have done? First we have done the steps directly. After that, point to point I explained, in the same way I will do for this. First, blindly believe me that you are going to get the concept in no time. Okay, now today, present value, today you borrowed 4,93,827. Yes or no? Today you borrowed 4,93,827. You borrowed today. After borrowing today, what you will do? I will convert. Okay, I will do what's a convert. Convert 4,93,827 into rupees at spot. So what is the spot rate? 1 pound equal to rupees 56. So take calculation. 493,827 into 56. Rupees 2 crore 76 lakh 54,312. This much I receive. I receive when this much amount? Today. So what I will do now? I will put in dustbin, deposit, deposit. So deposit rupees 2 crore 76 lakh 54,312 at 12% per annum for 3 months. So into, okay, first calculate 12 into, okay, 12% into 3 by 12 means how much? 3% means 3% means 1.03 into 276.54 312. How much I will get? Rupees 2 crore 84 lakh 83,941. Okay, 941. This much I will be having a realization after 3 months. Okay, I will explain you the logic of the each and every point. Once you copy down this particular thing, first copy down the notes. Once you copy like binomial model, point to point I will explain. I will not leave even a single issue inside this. Please copy down first. Believe me that you are going to learn the concept in no time. Please copy down first. Completed copying. Okay, see here now. Now let us go into the analysis. See here, now the numbers are there with us. I will explain. First listen carefully. What does this concept all about? Money market hedging says that, listen, using the money market, we have to hedge our risk exposure. How the risk exposure can be hedged using the money market? See the screen once. I will be actually receiving a particular amount of pound 5 lakh today na after 3 months, after 3 months. After 3 months, when I receive 5 lakh pounds on the day, dollar or pound can be 56, pound can be 50 also. Then I will lose a great amount. In order to protect from that forex fluctuation, companies can take a forward, okay, or they can go for a money market hedging strategy. Money market hedging is also very popular strategy of hedging, where they use the interest rates of two countries, okay, for hedging the forex risk. Okay, listen, I will be receiving today na after 3 months, after 3 months. When risk will not be there if I receive today, if I receive, risk will not be there. So receive today itself. Sir, he will pay after 3 months, sir. No, you receive by borrowing and converting. Means what? You borrow today in foreign currency and convert immediately at spot rate, such that you will receive everything today itself. Okay. So, sir, then I borrow na, sir. If I borrow, then who will pay this borrowing? This borrowing will be paid by the receivable you are getting after 3 months. Are you understanding the point? So this borrowing will be paid not by you. This borrowing will be paid by receivable you get. Simply to tell, this payable will be looked after by the receivable you get. Means the moment you borrow, happily you sleep. Don't bother about it. Who will pay, sir? Then if I borrow, if you borrow, it will be paid by the receivable you get. So you should not borrow receivable amount today, borrow present value of the receivable such that it matures to receivable after maturity, on the maturity date. Okay, after 3 months, 4,93,827 will be matured to 5 lakh pounds. Using the receivable, pay that 5 lakh pounds to them. That's all. Close the liability. So asset will close the liability. Okay, but the beauty is, the moment you borrow in pounds, you will put it in dustbin, convert, immediately convert. Means you are technically getting a spot receipt. You are technically getting what receipt, sir? Spot receipt. Sir, no, sir. If I would have waited for 3 months, na, I would have got 5 lakhs, sir. But now I am borrowing only 493,827, sir. Then how benefit will be there? Will be there. Do you know how? You will convert this into 56 today itself. You will convert it into 56 today itself. It will be converted into what? Rupees. In rupees, you will deposit that for 3 months at a 12% rate. Automatically, what will happen? 2,76,54,312, which you borrowed the amount by converting the pounds into rupee, that amount will be received today. So what you will do, you will deposit it for 3 months. Deposit it for 3 months, which matures to 284, 83, 941. Do you know what does it technically mean? See here, 2 lakh 84,008, 2 lakh, sorry, 2 crore 84 lakh 83,941 is the total receipt. So 284, 83, 941. So take calculator. 2 crore 84 lakh 83,941 divided by how many pounds you received, divided by 5 lakh pounds. Means how much you received? 56.97 rupees per pound you received. Spotlight you will receive only 56. Technically you got 56.97 per pound. Am I clear? Even though the market pound value depreciate, you will not bother about it, because forward rates are not involved in money market hedging. Okay, this is one way of understanding. Another beautiful way of understanding is there. See here, what is the strategy we are using? Money market hedging. Hedging means what? Uncertainty has to be reduced. Here what is the uncertainty? Pound rate may increase, pound rate may decrease on the maturity date. Okay, when uncertainty will not be there, if something happens today, uncertainty will not be there. Future is uncertain always. So avoid the future. Avoid what's our future? Either avoid future or lock the future today itself. Either avoid the future or lock the future today itself. Okay, so I can't avoid the future, but I will lock the future. How I will do? See there, I will ask you some questions. As if I am in front of you, answer this. Is it guaranteed that you will receive 5 lakh pounds after 3 months? Let us say default risk is not there. Creditor is a debtor is a good debtor only. He will pay. So now tell me, is that receivable after, is that receivable of 5 lakh pounds after 3 months is a certain, certain. 5 lakh pounds receivable is certain. So you will receive on after 3 months or not? Yes. That means the amount of pounds 5 lakh received is certain, uncertain, 100% certain. Okay. Assuming there is no default on the debtor. Sir, bad debts are leave off. That assumption model will not take. Okay. We assume that he will pay properly. So if that be the case, if there is no default risk, okay, assumption of the model, if there is no default risk, you would receive how much after 3 months? I will receive 5 lakh pounds. Certain, uncertain, 100% certain. Okay, certain. Next, do you know the interest rates today? Yes, 5% and 12%. Okay, that means you have a receivable in pounds. I need to create a payable in pounds. To create a payable here, you need to deposit a withdraw. You need to deposit a borrow na borrow. So borrow. Okay, borrow how much? Borrow at the prevailing interest rates in UK. At that time, what is the interest rate? 5%. For 3/12, it became 1.25%. Means borrowing of 4,93,827 borrowing today is a certain, uncertain, 100% certain. Okay, 4,93,827 today if you borrow, it will mature to 5 lakh after 3 months. That is certain, uncertain, 100% certain. Interest rates in India is 12%. Certain, uncertain, 100% certain. Spot rate in India today is 1 pound equal to 56. Certain, uncertain, 100% certain. The amount you borrowed here, you will convert to today. Certain, uncertain, 100% certain. That will be converted to 2 crore 76 lakh 54,312 today itself. Certain, uncertain, 100% certain. This if deposited at prevailing 12%, the maturity value will be 284,83,941. Certain, uncertain, certain. Everything is certain. There is no uncertainty. Issue may happen in the future, but what will happen, I know today itself. That means all these cash flows, whatever you are seeing here, these two are future cash flows, or present cash flows are future cash flows. But I can tell these future cash flows today itself. Or else you can understand in another way. Today we are sitting and listening to the class and we are only understanding that you will receive this much amount. If really this is a factual information given. So nothing is uncertain, everything is certain. That itself is a concept called as a hedging. Okay. So the beauty of the money market hedging is events may happen in the future date, but everything what will happen we know today itself. Okay. Listen again. One last time I will repeat. We are having a receivable exposure, payable exposure, receivable exposure. You will receive today na after 3 months, after 3 months. Risky, not risky, very, very risky. Okay, the price may fall in the future date. Okay, therefore it is very, very risky. Okay, now when if it received, if it is not risky. If I receive today, it is not risky because fall in dollar cannot be there. I will convert in spot rate. So receive today itself. Sir, how will I receive today, sir? Receivable will be made in 3 months. Borrow in that currency and immediately you have to convert. Okay. So borrow and convert. Why borrow? You are having a receivable after 3 months. So create a counter payable for this. In order to have a liability for the asset, you are having a asset. Create a corresponding liability. To create a liability in pounds, you need to deposit a borrow na borrow. Borrowing is a liability. This liability has to mature to 5 lakh. Means I need not borrow 5 lakh. I need to borrow present value of 5 lakh. So you borrowed this much amount. Okay. Keep it ideal. Deposit immediately convert into rupees and deposit in rupees. That deposit will mature to this much. Means borrowing of 4,93,827 pounds you have made, you need not bother about them because this borrow will mature to 5 lakh. That 5 lakh will be paid using your receivables. These two will strike off each other. You need not again bother. Okay. So future foreign currency asset will be knocked off by foreign currency liability. Therefore in home currency you need not make any conversion. Conversions if any has to be made, you will make at the spot rate today itself. Okay, so you converted them. This much amount you got. This amount is received when today on conversion at spot rate you are converting. This amount you will keep it ideal or deposit deposit that mature to this much amount. This is what he want to convey. Okay, this is one problem with the single quotations we have done. Two-way quotations also, if you do the problem, you will get full clarity. For that, let us take another question. Before that, we go to futures hedging question number 5. Futures hedging question number 5. This is a 12 marks question came in exam, 8 marks it came in exam, 8 marks it came for 4 times in examination. Ditto question they are giving with a change in numbers. No surprise in your attempt again if it is coming. Okay, let's see. Okay, see here. XYZ Limited is an export-oriented business house based in Mumbai. The company invoices in customers' currency. Its receipt of US dollar 1 lakh is due on September 1st, 2009. Market information as on June 2009 is as follows. Next, exchange rates. Exchange rates. Dollar by rupee spot 0.02140. 1 month forward 0.02136. 3 months forward 0.02127. Currency futures dollar per rupee, contract size rupees 4,72,000. June futures, September futures. Okay, always June means June expiry, September means so June means June expiry, September means September expiry. Particulars, initial margin and interest rates. Particulars, June initial margin interest rate, September initial margin interest rate. On September 1st, 2009, spot rate of US dollar to rupee is 0.02133 and currency future rate is 0.02134. Convergence is there, both are same. 0.00001 difference. Ignore that convergence. Comment which of the following methods would be more advantageous. Using a forward contract, using currency futures, not hedging the currency risk at all. It may be assumed that variation in the margin would be settled on the maturity of the futures contract. This is the question that is being asked. Please read the question before we go on with the solution. Please read the question, very, very important from the exam's point of view. Read the question. So hope you have read the question clearly. Let us start. XYZ Limited is an export-oriented business house based in Mumbai. The company invoices in the customer's currency. First point, we have a receipt of payment receipt in US dollars 1 lakh. Okay, now first point number 1. Let us tick the information which is relevant. Okay, market information as of June 2009 is as follows. Okay, market information as of the June 2009 is as follows. Let us see what is the information that is being given. Okay, so first, spot. Spot is relevant or not relevant? Technically, spot is not relevant for us. Do you know why? In spot, we are not going to do any of the transaction. Okay, in spot, we are not going to do any of the transaction. We are making the transaction on which date? Export we are making in June. Okay, receive will be made on September. Means June if you do, September 1st he said, means August 31st you can take. June 1st you made, 1st June, July, August, means how many months after you will receive? After 3 months you will receive. So 3 months forward rate is relevant. Number 1 over, tick that. Okay, next, currency future size we require because for the standardized lot size. Next, you require June currency futures or September currency futures. We require expiry date. Okay, what expiry? September it should expire. So this is relevant. June means not June opening. Okay, June expiry. June means September means September expiry means September expiry. That value is available today at 0.02118. That's the meaning. Okay. So let's continue. Next, September month is relevant for us. Okay, next, on September 1st spot rate means on September 1st, if you don't hedge your risk at this rate, you have to realize, relevant. Okay, in the futures market, the expiry is going on at 0.02134. Which of the following methods you will use? That's what he is asking. Okay, let's do together one by one. First, keep the heading. Question number 5. 5. Question number 5. Let us first write down facts for clarity's sake. Receivable. How much receivable? $1 lakh. Next, term 3 months. Term is 3 months. Next, September futures on June 1st. ₹1 equal to dollar. It was given as indirect quotation. ₹1 equal to dollar 0.02118. Okay. September forward rate ₹1 equal to dollar, exchange rates given. Okay, forward 0.02127. Okay, next, actual exchange rate on September 1st, ₹1 equal to dollar 0.02133. 23, 234. 2133. Actual futures rate on September 1st, ₹1 equal to convergence 0.02134. just last digit small change. Okay, these are all the rates that are given. Okay, next. So standardized lot size equal to rupees 4,72,000. 4,72,000. This is the information that is being given. Write down. First, using forward. So first let us use the forward hedging as a strategy. Okay, first write down. Forward rate 1 rupee equal to dollar 0.02127. How many dollars I have to receive? 1 lakh. So tell me how much I will receive. 1 lakh divided by 0.02127. I will receive rupees 47 lakh 01457 if I receive using forward. Next, no hedging. If I do not use any hedging, what would have happened? 1 rupee equal to dollar 0.02133. I have to receive how much? Dollar 1 lakh. How much I would have received? 1 lakh divided by 0.02133. Rupees 46 lakh 88,233 I would have received. When I would have received? If there is no hedging. Next, number 3. Hedging through currency futures. What I said yesterday, whenever you are hedging through currency futures, peace of mind lo open your exposure in the cash market. Okay, so 2 positions. How many positions? 2 positions. Cash market, futures market. Cash market la don't enter into forward again. Don't go to 2 hedging. Overaction it will become. Okay, forward hedging you futures market is a hedging strategy. Futures la really you will not receive dollar, pay dollars. Futures la margin la you will get a income. If there is a loss here, gain will come here. Okay, so and vice versa, like yesterday we have seen. So in the currency market, what could have happened? If the currency market, I will be keeping my exposure uncovered. Means what will happen? Same thing. 1 rupee equal to 0.02133. 0.02133. Okay. So I will receive how much? Same previous answer. 1 lakh means this will you receive rupees 46 lakh 88,233. Now very important, listen carefully. Very important, listen carefully. First point number 1. In the futures market, there will be 2 things that happens now. Sir, only one thing can happen, sir? No. 2 things will happen in this example. Why? I will explain. First, there is a margin cost. What cost? Margin cost. Okay. Answer my question clearly. First, we need to know number of contracts you need to trade. What you should know, sir? Number of contracts you need to trade. See here. Here I will write. Working note. Number of contracts. Number of contracts. Tell me. What is the invoice value? Dollar 1 lakh. Dollar 1 lakh. Okay. What is the futures rate? Very important point. Futures are dollar futures or rupee futures are traded because standardized lot size is given in rupee. Quotations are also given as a per unit currency as a rupee. These are not dollar futures. These are all rupee futures. Okay, so futures rate 1 rupee equal to dollar, how much? 0.0218. Okay, I have how many dollars? 1 lakh dollars. Tell me. 1 lakh divided by, everyone do, 0.02118. How much it will become? It has become rupees 47 lakh 21,435 rupees. Okay, what is the standardized lot size? Standardized lot size is rupees 4,72,000. Okay, means how many number of contracts I need to enter? Divided by 4,72,000. Exactly, you need to enter into 10 contracts. How many contracts are? 10 contracts. So the given quotation is in per unit as a rupee. Okay, now listen carefully. For 10 contracts I need to pay margin money or not? Okay, see the question and tell me what is the September margin deposit. For contract we need to pay 15,000. Opportunity cost is 8%. Opportunity cost is how much, sir? 8%. Okay, so now listen carefully. Margin cost 15,000 into 10. Okay, how many contracts? 10 contracts. So how much? Rupees 1,50,000. Rupees 1,50,000. So simply what he want to tell is 15,000 rupees you need to pay as a initial margin. Per contract you need to pay. How many contracts are there here totally? There are totally 10 contracts. You need to pay this much amount as a margin cost. Up to here, understood? Next. Okay, so 15,000 rupees per contract I need to pay. Margin cost represents not margin deposit, opportunity cost of interest. Sir, why sir 1,50,000 is also cost, sir? No sir, margin will be refunded back na. Why it will be called as a cost? If you get a profit, along with the profit it will be given back. So margin money is what you put and what you get back. If you lose, you will pay. Let us see whether you are getting loss or gain. So on this 1,50,000, okay, you are losing a interest of, in India how much interest? 8%. For how many months? 3 months. 1,50,000 into 8% into 3 by 12 rupees 3,000 is the margin cost. Okay, everyone now answer. I am a exporter, importer. I am a exporter in the given case. Export oriented. Exporter will have a receivable or payable or receivable. So I want a guaranteed buying price, a guaranteed selling price, a guaranteed selling price. Therefore, we need to enter into buy futures or sell futures. Sell futures. Wrong. Here the per unit currency given is the rupee. We should see what is happening to the rupees. That's the important thing here. Student will think one thing. Student will think about one thing. In the institute statement, answer will come reverse. He will not have a clue as to why it is happening. Put option, call option also same thing in currency futures and options. That misclarity we are going to break today. Listen again. In reality, from the importer, you are going to receive, you are an exporter, you are going to receive $1 lakh. That is cash market transaction. I'm talking about futures market. Futures, the transaction is quoted in rupees and in dollars. In rupees it is quoted. Therefore, what is happening to rupee we should tell. That's why from the very beginning of Forex we learned in the same way. We didn't convert it into direct quotation. Do you know why? In Forex you can convert direct indirect. In case of currency options and futures, you can't convert into direct indirect because the quotations are not given by the banker. Quotations are given by the stock exchange. I don't know how many of you are listening to you know this concept. In case of currency options and futures, rates given there are traded not by the banker, they are traded by the stock exchange. That's why forward market la banker will quote the quotations. Therefore, direct quotation, indirect quotation will be there. Ask and bid will be there. You see any kind of currency option, currency futures question? See any question? Show me one place where there is ask and bid quotation. Will not be. Now listening to this, how many of you now you came to know that there will not be ask and bid for currency options and futures? Okay. So I am telling you, people are doing for namesake. Problems means, okay, this problem, if it come like this, do like this. But reality behind that is currency options and futures concept la, there is no ask and bid. Do you know why? It is not a banker who is quoting that particular amounts. It is the exchange which is giving the quotations. So therefore there will not be a concept of an ask and bid. Okay, sorry. In forward it will be there, because forwards are not traded by the exchange, forwards are traded by the banker. Okay, so therefore next one, margin cost is 3000. Okay, now let us see. I am an exporter, importer. Repeat again. I am an exporter. I will receive dollars, pay dollars. Receive dollars means I will pay in what? I will pay in rupees. So rupees are paid. Okay, means simply to tell, we will sell dollars means we will buy rupee. We will sell dollars. We will receive dollars here, exporter. You will sell dollar to the other person. When you sell dollar, what is happening to rupee? Sell dollar and buy the rupee. Reversely, you can buy rupee. So buy rupee, we need to enter into, okay, rupee buy. At how much? At how much? Dollar futures 0.02118. Really you will buy, you will take a counter sell, you will take a counter sell. On the date convergence is there, it is 0.02134. Okay, your sell, your buy. In this you are making a gain or loss? Making a gain. How much gain? Dollar. Take 0.02134 is the sale price, minus 0.02118 is the profit, means dollar 0.00016. Okay, 0.00016, 3 zeros. Okay, this much profit. So that's much low profit, sir. That's per rupee. Okay, for 1 rupee you are making dollar 0.00016. Okay, okay. Now how many rupees of contracts you entered, sir? You entered totally into number of contracts. How many contracts you entered? 10 contracts. Number of rupees per contract equal to 4,72,000. 4,72,000. So 4,72,000 into 10. Okay, so 1 rupee equal to dollar 0.00016. Okay, 0.00016 for 47 lakh 20,000. How much you enter? So gain in dollars equal to dollar 755.2. Dollar 755.2. I will write here. Okay, how I got? Take calculator. 0.00016 is the profit per rupee. Totally how many rupees? 47,20,000. Means how many dollars you got? $755.2 you have got. What is this? This is a gain. Tell me, this gain I will receive today in September, in the month of September. This gain I will receive into the margin account. Into what account? Margin account. I need to convert this into rupee and then I have to take this margin amount. Okay, so tell me, 755.2, listen carefully, confusion no. $755.2 is a profit I received today na, after 3 months. After 3 months. Okay. After 3 months you will really receive this profit. Fake. Really I will receive. What is only fake? Buying I will not buy. Selling I will not really sell. For a buy I take a counter sell, only profit will be booked into the margin account. Per rupee, $0.00016 is the gain. So for 47,20,000 rupees, I will receive $755.20. This $755.20 has to be deposited in a rupee margin account. To have a rupee margin account deposit, I need to convert using a rate or not. At what rate you will convert? You can't convert using futures rate, because futures is the real, not delivery. You can't convert using forward rate because you don't know that you will get a profit of 755.2 today itself, because 755.20 is dependent on 0.02134, which is uncertain. Okay, 0.02118 is a rate blocked in the June itself for September future, but 0.02134 is a rate prevailing actually on September 1st, which you don't know today itself. So you can't enter into forward rate. That means you can't go to the bank and tell banker, I will sell $755.20 to you on 1st September. You can't tell like that, because this 755.20 has come because it is 0.02134. 0.02134 I don't know. Therefore 755.20 also I don't know. That has come, that's all. Okay. So I don't know that I will get to 755.20 on maturity date. I got. What I need to do? Convert. At what rate? At the rate prevailing. At the rate prevailing. That means 0.0. This rate only will apply. Sorry. This rate only will apply. Okay. This is the rate prevailing actually in the banker. With the banker, this is a rate traded. So therefore, rupee gain. Rupee gain. 1 rupee equal to $0.02133. How many dollars you have? 755.20. So how much is the gain? 755.20 divided by 0.02133. 35,406. Okay. But in this there is a cost. Okay. So net gain 35,406 minus 3,000. How much? 32,406 is a gain. Okay. How much I will receive in the future in the cash market? 46,88. On that, how much gain is added? 32,406 plus 46,88 to 33. It is rupees 47,20,639 is the total receipt. That means you will receive 47,20,360 This is the amount total you receive if you go by the futures. Futures la real delivery only margin profit. That margin profit is important. If you go by forward, 47,01,000. If you go by no hedging, 46,88. If you go by currency futures, 47,20,000. Okay. That means cash market lo you will not cover again. You will put the exposure uncovered. Okay. But in the futures market, the margin balance itself is the boon. Okay. That means you deposited 1,50,000 now, 1,50,000 plus 3,000 will come back. Means you will receive 1,53,000. Sir, then you have to add 1,50,000 you put 1,50,000 you came back, means you have a cost of 1,50,000, you have an income of 1,50,000, both will cancel each other. Net cost you need to understand. How much is the net cost? 3,000 is the net cost. Okay, this is the cost of futures. This is a gain from futures. This is a net gain from the futures. This gain is added to the cash market receipt. Okay, sir, how we pleasantly slept by opening the exposure uncovered? How the naked exposures are put? Naked exposure means it is not covered with the instrument. That's why whenever you go to the futures market, in the cash market you will keep your exposure uncovered. Happily you sleep. Futures will take care. Okay, this is how it will be. Please copy down this particular point. Completed. Hope you completed copying. Enough time given. So this is how we need to do the futures problem. I think everyone understood how to do the question now. Okay. So we completed 1, 2, 3, 4, 5 and 10th. So now we need to do 6, 7, 8, 9. Okay, 6, 7, 8 and 9. Okay. Let us now take question number 6. Okay. See the question. XYZ Limited, a US firm, will need pounds 3 lakh in 180 days. In this connection, the following information is available. Spot rate 1 pound equal to $2. Forward rate 1 pound equal to $1.96. Interest rates are as follows. Particulars UK US. 180-day deposit rate 4.55, 180-day borrowing rate 5.5. A call option on pound that expires in 180 days has an exercise price of $1.97 and a premium of $0.04. XYZ Limited has forecasted the spot rates 180 days hence as below. Future rate $1.91, probability 25%, $1.95, probability 60%, $2.05, probability 15%. Which of the following strategies would be most preferable to XYZ Limited? Forward, money market, options, no hedging. So 4 concepts he asked. This question came for 8 marks in examination. Okay. So first point number 1, you read the question. Take 2 minutes time, no problem. Okay. As if you are doing in examination, sincerely first read the question properly. Okay. Half the question you can also do, because forward rate, money market hedge, no option, no hedging you can also do. Only one new concept is there, options. That I will explain how to do. But remaining concepts I think you can do. Okay. But even before that, read the question first. We will do together all the points. Okay. Read the question. I will give time. Read the question properly. Okay. See here now. So XYZ Limited, US firm, will need pound 3 lakh in 180 days. Means it need pounds, means it has to pay. Okay. So therefore he has given questions. Question they have clearly given call option. Call option means an option to buy. Option to buy. Okay. Now tell me, which currency we need to pay? Pounds. Which is the per unit currency? Pounds. Fantastic. Happy question. Okay. First happy question. Previous example, I will receive in dollars, but the transaction is quoted in rupee. Headache. This question was asked directly. Okay. Let us do together. First, forward contract. Which contract? Forward contract. Okay. So tell me what is the forward rate? $1.96. $1.96. Pounds, how much? 3 lakhs. Huh? Yes. Do 3 lakh into 1.96. Okay, over. Second, if I go by no hedging, okay, if I go by no hedging, three things can happen. Okay, price can be 1.91, price can be 1.95, price can be 2.05. Okay, first write down probable price of pound per dollar. Sorry, dollars. Dollar per pound. Okay, probable. Tell me, how much is probable? $1.91, 25%, plus 1.95 60% plus dollar dollar 2.05 15%. 1.91 into 0.25 0.4775 plus 1.95 into zero point 0.6 1.17 plus 2.05 into 0.15 0.3075. What is the probable price? 1.955. 1.955. Okay. Now, so 1 pound equal to dollar 1.955. How many pounds I have? 3 lakh. 5 lakh 86,500. 5 lakh 86,500. Now, which is better when compared to that? No hedging better, forward better? No hedging better, people will tell. No hedging is better, provided your expectations comes true. If these changes, automatically this is always risky. Okay. Okay. No hedging means you are not covering the risk. That's only your expectation. Number 3. Let's go by MMH. Let's go by what, sir? MMH. Okay. Now, first MMH. We are having receivable, payable, payable. Okay. Mode of doing the problem will change now. First, everyone draw 4 boxes. Follow this box approach. Never you will commit mistakes. I am the guarantee. Okay. First, what is the foreign currency for us? USA is home currency. UK is a foreign currency. Traded in pounds, traded in dollars. Okay. Now tell me. Transaction happens today, na? Transaction will be received. I mean, the payment you have to make today, na? After 180 days, this is T180, T180, T0, T0. Future value, present value boxes. Never you will commit mistake if you follow this table. First, blindly only do what I say. First thing, you are having a payable or receivable payable. Today na after 180 days after 180 days. In pounds in dollars pounds. So 3 conditions. Pound la after 180 days okay payable. Okay. So first thing there is a payable. Okay, today na after 180 days, that's why future value table T180 la. So pounds 3 lakh. Okay, pounds 3 lakh. Okay, this is asset or liability? Liability. You need to counter this liability using an asset, using a asset. How much asset should be created? Pound 3 lakh should be created. This asset created should pay that liability in future. Okay, to create an asset here, you need to make a deposit here, a borrow here, you need to make a deposit. So deposit, present value of pounds 3 lakh. Present value of pounds 3 lakh. Now answer my question clearly. To deposit 3 lakh pounds in the USA, in the UK, how you got 3 lakh dollars? We are from USA. Okay, we have to deposit pounds in UK. How can you deposit pounds in UK? You borrow in dollars, convert into UK pounds. That means first you need to make a borrowing. Okay, first tell me what is the present value of pounds. pound la what is the interest rate? UK la 180 days, which rate you need? Deposit rate you need. Means which rate? 4.5. 180 days rate 4.5. Again, don't make per annum. Already he has given clearly 180 days rate 4.50. If we give rate of interest is 4.50 and given the information 180 days, you need to convert. Question A, he said 180 days deposit rate 4.5. Again, don't reconvert them. Okay. So, see here. PV equal to FV divided by 1 plus R. Tell me now, what is the future value? Divided by 1.045. 4.5 yes. So 3 lakh divided by 1.045. How much? You have to deposit pounds 2 lakhs 87,081. How can you deposit 2,87,081? You will print pounds. You will borrow dollars equivalent to pounds 287,081. So today tell me what is the dollar rate at the spot? T0 means spot. 1 pound equal to dollar. How much is the spot rate? 2. Okay, how many pounds you need? 287,081. Means how many dollars? 287,081 into 2. 574,162. 574,162. What is this 574,162? 574,162 is the amount that you need to borrow. After borrowing, what you will do? After borrowing, convert into pounds at spot rate. So you will first borrow this much amount. You at the spot rate you will convert. What will happen? 5,74,162 divided by 2 means it will get converted into 287,081. So okay. Now you will borrow here. When you borrow here, what you need to do? After 180 days you have to repay. Repay borrowing. Repay borrowing. How much? The interest rate in USA. Borrowing rate in USA. How much? 5.5. 5.5. Okay. So 5,74,162 into 1.055. How much? 574,162 into 1.055. How much? So you will pay an amount equal to the following: 6,05,741. 6,05,741 is the net payment you are going to make after 180 days. If you use money market hedging, means technically for 3 lakh you have paid this much amount. Okay, for 3 lakh pounds you spend that much amount. Okay, now listen carefully what we have done. Reverses are payable na, exactly you have to make a reversal. Okay, let us analyze this. You have to make a payment, that means you have a payable exposure, receivable exposure, payable exposure. Payable exposure in rupees are dollars are pounds are pounds. Our home currency in this question is dollars. Okay, our home country is dollars, means USA. Our country in which you made a foreign exchange transaction is UK. So you need to you have a payable exposure. Payable of how much? 3 lakh pounds. So payable is a liability. So we need to create a corresponding asset. To create asset in pounds, you need to deposit. So how can I deposit? I am from USA. Borrow in USA today and deposit today. Okay. Once you borrow in dollar, your liability will be in home currency or foreign currency or home currency only. How much is the net liability? 6,05,741. You will convert everything today. Okay. That means, listen carefully. Your payable of 3 lakh pounds after 180 days is a certain uncertain? Certain. Okay. Because of this, when if you pay, risk will not be there. If you pay today, risk will not be there. So how to pay? Borrow and pay. So borrow in home currency. Home currency is dollar. Equivalent to this much amount you need to borrow. You borrowed. You borrowed 5,74,162. You borrowed how much? 5,74,162. You borrowed 5,74,162 dollars, converted that into pounds at the spot rate. Okay. So you borrowing 5,75,074,162 today is certain. Converting at the spot is certain. That is getting converted into 287,081 is certain. That maturing to 3 lakh is certain. This 3 lakh receipt deposit amount maturity used to pay this 3 lakhs is certain. Everything is blocked today for what has to happen in the future. Okay, but the net cost is very high in money market because of interest rates. It is 6,05,741. Okay, so if you compare than forward than no hedging, money market hedging is very very costly, because in this question we are not having receivable, we are having a payable. Costly payable it is. Okay, last one. Sir, okay, anyway, copy this. If you didn't copy, I will give you 2 minutes time. Please copy this first, then we go to last one called as options hedging. So hope you have copied. Go to the next part now. Next. So we have done money market hedging also. We have got a heavy payment. Next. Last one. So this will be Currency options. Okay. Now listen carefully to the point. Currency options. Okay. So first point number 1. Currency options, we need to first know the strike price. First know what's the strike price. How much is the strike price? Strike price is 1.97. 1.97. What is the premium? 0.04 is the premium. Now what he is asking, 180 days rate is given, either this can happen or this can happen or this can happen. If this happens, what you do, this happens, what you do, this happens, what you do, we need to tell. Okay, listen carefully. Situation, strike price, actual price, action by call holder, outflow, premium, total outflow, probability, outflow into probability. See here. Situation 1, 2, 3. Strike price I blocked will be 1.97. Okay. Next. What is the actual price? Actual price can be 1.91, dollar. Okay. First, I have a chance to buy a dollar in the market at 1.91. I will exercise a lapse. Second case, I have a chance to buy the dollar at 1.95 itself. I will exercise a lapse. I have a chance to buy a dollar which is available in the market at 2.05, 1.97. Exercise a lapse, exercise. Outflow. In the first case, how much is the outflow for me? How much is the outflow for me? I will use 1.97 data, 1.91, 1.91. So 1.91 into, okay, 1.91 into, okay, tell me, what is the total outflow that I will be bearing? Question will arise or not? What is the total outflow that I have to bear? Or I will do one thing. You can first add premium also here. How much is the premium? $0.04. Okay. Okay. Now, what is the net cost? Total outflow. I'm writing directly here. I'm erasing this. Okay. Okay. Listen now. Let's do. So what is the total outflow? 1.91 plus 0.04 means 1.95 into 3 lakh pounds. 5 lakh 85,000. 5 lakh 85,000. So the total outflow we need to calculate. Yes, calculated. Next, here 1.99 into 3 lakh. 5 lakh 97,000. Next, here I will pay 2.05 or 1.97. I will pay 1.97. 1.97 plus 0.04 will come to 2.01 into 3 lakhs. So which will be finally coming to 6,03,000. This is guaranteed or probable? Probable. Chance is there. So how much is the probability? 0.25, 0.6 and 0.15. So 5,85,000 into 0.25, 146,250. 5,97,000 into zero point 0.6, 358,200. 6,03,000 into 0.15, 90,450. So the total you have to pay will be 5,94,900. 5,94,900. This is the total cost you need to bear, plus interest on premium. Instead of adding the premium here, in the three cases the same amount I will add directly here itself. Interest on premium. Okay, interest on premium. Premium will be always paid on the total amount. Okay, on the total amount we will pay the premium amount. So totally $3 lakh is the value into, you have pound 3 lakh into 0.04 into I will pay the premium in which currency? In my home currency I need to pay. Okay, in my home currency, from it only I have to pay. In home currency, how much is the opportunity cost? 5.5%. So 3 lakh into 0.04 into 5.5%, 660. 660. I will pay in US pounds only, but first I need to have dollars to pay na. That means dollar opportunity cost is there. Plus 594, 400. It is 5,95,060. This is the total net outflow. Using what? Using currency options. So which of the option is better? 595,060 in options, 605,741 in one case, 588 in one case, 586 in another case. What is the best one? So it is better to go for no hedging in this given case, because the option is very less, but this is subjected to a risk. If not, you can go for the first option called as a forward hedging. Okay, please copy down the last case. So the next problem. So we completed problem number 6. Next one, question number 7. Maybe more complicated. Let us read the question first. A Limited of UK has imported some chemical worth US dollar 364 387 897 from one of the US suppliers. The amount is payable in 6 months time. The relevant spot and forward rates. Spot rate, forward rate. The borrowing rates in UK and US are 7% and 6% respectively, and deposit rates are 5.5 and 4.5 respectively. Currency options are available under which one option contract is for GBP 12,500. Options premium for GBP at a strike price of US dollar 1.7 per GBP in US dollars, 0.037 call and 0.9096 in put option for 6 months period. 3 choices. One is a forward, another one is money market, third one is a currency option. Which alternative is preferable? 8 marks. First read the question carefully before we go with the solution. Success will be there only in reading the question. So completed. So A Limited of UK has imported a chemical worth US dollar 3,64,897. Okay. So this is the question that is being given from one of the US suppliers. The amount is the amount is just a minute. So A Limited of UK has imported A Limited of UK has imported chemical worth US dollar 364,897 from one of the US suppliers. Payment has to be made in the dollars 364,897. Payment will be made in 6 months time. Spot rate is 6 months forward rate given. Forward cover, money market cover, currency option. First let us do the first two clearly. After that we can look after the second one. Okay, let us start with the first one. Since he didn't give anything with regard to this, let us consider with 1 or 2 assumptions and let us start. Okay, see here. Here also the rates are given as 7%, 6%, 5.5% and 4.5. Sir, how to understand this? This confusion is students are having. In the previous question he clearly said 180 days borrowing rate deposit rate. Here he didn't give that clarity. Therefore you will take it as per annum. If clearly he said that the 180 days rate like that and didn't use per annum, now you can directly take that rate. But here he didn't use like that. Generally he said borrowing rate. Okay, we have to convert that into 6 months period. Okay, that's the point. Currency options are available under which one option contract is 12,500. This is the standardized lot size. Option premium for GBP at a strike price of US dollar 1.7 per GBP is 0.037 for a call, 0.096 for a put for a 6 months period. First let us do the forward. Question number 7. forward cover. Okay. How the forward cover has to be taken? Forward rate we need to consider. 6 months forward rate. Okay. Let us first write down 6 months forward rate. Okay. UK firm imported from US dollars. Okay. How the quotation is given? 1 pound equal to dollar 1.5455 dash dollar 1.5609. 1.5609. Okay. So this is the amounts. So now listen carefully to the point. This is the quotation. Now listen carefully how to do the solution for this. Okay. Listen. First, normal forex question. We have to pay in dollars, but the quotation is given in pounds. Therefore, understand everything in the pound point of view. We need to pay in dollars means we need to pay in dollars means we are importers. We are the importers from UK. We need to pay in dollars means we need to buy dollars. Dollar buy means pound sell. So we need to sell pound. Bank has to buy pound. Bank buys at a lower rate. Lower rate will be the bid rate. So the quotation is bid of, quotation is on pound, dollar by pound. Okay. Okay. Now bid of dollar by pound. What is the bid of dollar by pound? 1.5455. So 1 pound equal to dollar 1.5455 dollar 3 lakh 64,897. How many pounds we need to pay? 364,897 divided by 1.5455. It is pounds 2,36,103. 2,36,103. Please first copy down up to here, everyone. Complete it fast. Okay, completed. Next. So this is the first part. If you go by a forward cover. Next, money market hedging. Again, we have payable, receivable, payable. Okay, 4 boxes. First, let us see. Okay, first, this is a 6 months contract. Na? Let's write down the detailing properly. Our home currency is UK. Payment should be made in USA. It will be paid after 6 months. Okay, I will write T 6 months. T 6 months. T0. T0. Future value, present value. Okay, future value, present value. So tell me now, one by one. We are going to have a payable exposure, receivable exposure, payable liability. Okay, payable exposure, which is called as a liability. Okay, how much payable? Dollar 3 lakh 64,897. I need to create a counter receivable to this. How much? Same 364,897. Like this you need to write. Okay, then you will not commit mistakes. So we need to create an asset. To create a dollar asset, borrowing will create an asset, or deposit will create an asset, or deposit. So I need to deposit present value of dollar 3,64,897. 3,64,897. Okay, 3,64,897. I need to deposit. Listen now. We are from which country? UK. We need to deposit money in which country? USA. How to deposit this money in USA? A question will arise or not. We have to borrow in UK pounds and convert those pounds into dollar. At what rate? At spot rate. So tell me, what is the rate that will be prevailing? You should only tell what is the rate that is prevailing. Even before going into this, first answer. We are going to deposit in USA na, in UK na. In USA we are going to deposit. Means we require UK deposit rate, UK borrowing rate, US deposit rate, US borrowing rate. We need US deposit rate. Deposit in USA 4.5%. Okay, see here. Future value, sorry, present value equal to future value divided by 1 plus R. 1 plus R. Okay, now future la I need a value of how much? 364,897 divided by 1 plus, or directly I will write R. R is 4.5 into 6 divided by 12. 2.25 means 1.0225. So 364,897 divided by 1.0225 means dollar 3,56,867. You have to deposit dollar 3,56,897 today, which matures to 364,897 after 6 months. That will pay the liability directly. So deposit, everything is made today. You are very much riskless. So today what you will do, at the spot rate you have to convert. Means like this the arrow mark should be. That means I need to convert what into what? First I need to borrow pound equivalent amount of dollar 356,867. Okay, at what rate? Spot rate. Now listen carefully and answer. Quotation is given as a as a per unit currency in what terms? In terms of pounds. In terms of pounds. Okay, 1 pound equal to he has given. 1 pound equal to he has given. Very litigant question is asked in exam. Listen carefully to the question now. Okay, first point number 1. Tell me, we are borrowing in which currency? Dollar. Okay, we are borrowing in which currency? Pound. Equivalent amount of how much? 356,867. This pounds borrowed should be converted. Means how many pounds we need to borrow is a question now. When you are borrowing, Spotlight will borrow. Spotlight will borrow that much amount of pounds, which after conversion will be converted into 356,867. So first tell me, we will sell the pounds and convert them into dollars. We will sell the pounds and convert them into dollars. We will borrow some pounds. And what we will do, we will sell to the banker. Which one? What we will sell? Pounds we will sell. And we will convert them into what? Dollars. Okay, we will sell the pounds, buy the dollars and deposit them in USA. That means what is the activity we are doing now? We will borrow the pounds, sell the pounds to the banker and buy the dollars, and the dollar will be deposited in USA. That will be paying the liability. Means what is the activity on pound? Pound is a per unit currency. What is happening to the pound? I want now. Tell me. I will borrow in pound, deposit in pound, borrow in pound. After borrowing in pound, what you will do? You will sell the pounds to the banker. Okay, you need to deposit in dollar, means you have to buy dollar. By selling what? Pounds. You have to sell the pounds, bank has to buy the pounds, bank buys at a lower rate will be the bid rate. Repetition once again, you are selling the pounds, bank has to buy the pounds, bank buys at a Lower rate. Lower rate is the bid rate. Bid of dollar by pound. Okay, I'm doing the calculation here. Bid of dollar by pound spot means 1 pound equal to dollar. Bid 1.5617. How many dollars I need? 356,867. So how many pounds? 356,867 divided by 1.5617 means 2,28,512 pounds you need to borrow. Okay, when you borrow in pounds, automatically you have to pay the interest on the borrowing pounds or not. So maturity value of borrowing. Okay, maturity value of borrowing. So pounds 2,28,512 into what is the borrowing rate in UK? 7%. Okay, 7% into 6 divided by 12, 1.035. So 228 512 into 1.035, it is pounds 2,36,510. 2,36,510 is the payment you have to make as per money market hedging. As per money market hedging. Okay, so 236 510. 236 510 is a payment using what? Payment using the money market hedging. Money market hedging, this much you need to pay. Okay, forwardly you will pay 236 103. Next, last one. Currency options. Which one? Currency options. Okay, so see there. First point number 1. Tell me, we are going to make the payment receipt. We are importers or exporters or importers. We need to pay in dollars or receive in dollars. Pay in dollars. We need to pay in dollars. Okay, that means when I want to import, I have to make a payment. Okay, in what currency I imported? Dollar currency I imported. So I need to pay in dollars. So I need a guaranteed buying price, a guaranteed selling price, a guaranteed buying price of a dollar. Okay, so guaranteed buying, I want to buy in future. Which option I need to enter for buying? I want a guaranteed buying. Which option I need to enter? Call option or put option or call option. So what is the call option rate? 0.037. Wrong. Like this you should not think. Again the same mistake you will commit if you do like this. Transaction is made on pound. What happens to the pound you need to understand. Like rupee futures we have done in the previous problem, one of the problem. Now like that it is a GBP traded. So therefore what happened to the pound you need to tell. So tell me, we are importers or exporters? Importers. You need to pay in dollar or receive in dollar? Pay in dollar. Means what happens to the pound? You have to buy the pound, sorry, you have to buy the dollar and sell the pound. Sell the pound means on pound you require a put option or call option. Selling pound means option to sell is what option? Put option. This is a relevant rate. Okay, this is a relevant rate. GBP la strike price is 1.7. Standardized lot size is 12,500. Okay, very difficult area. I will first do. I will explain 1 or 2 times. Exact institute answers with decimals also we will tally. Okay, how to do, but that will be the important point. Okay, first I will do and I will give time for you to copy. First, required contract is a pound sell, means pound put option I need to enter. Which put option, sir? Pound put option I need to enter. Okay, so I need to enter into a pound put option. First point occur. Now listen carefully one by one. First point number 1. What is the don't write invoice value? Dollar 364, 364 897 if I am not wrong. Yes, 364,897 is the invoice value. Okay, now first point number 1. At what rate I need to convert this? At the futures rate I need to at the option for put option value of a pound we need to convert. Okay, relevant rate, strike price we need to give. What price? Strike price. Okay, now strike price is how much? 1.70. 1.70. 1 pound equal to dollar 1.70. Dollar 1.70. Number of pounds value. Why? Because trade is made on pounds means everything should be first converted into pounds. 1 pound equal to dollar 1.7 strike price. Okay, we want how many dollar? 364,897 divided by 1.7 means how much? 364,897 divided by 1.7. How much? Pounds. 2,14,645 pounds. Okay. Number 4. Standardized lot size. Pounds. How much is the standard lot size? 12,500. So number of contracts. 214,645 divided by 12,500. 17.17 contracts. 17.17 contracts. So rounded off and approximated to 17 contracts. How many contracts? 17 contracts. This is A bit. First, what I have done, I will explain first. How much is the invoice value? 364,897 is the dollar invoice. Okay, sir, why you converted into pounds? Contract, everything is given in pound terms. If he would have given the contract in dollar terms, directly 364,897 divided by standardized lot size we would have calculated. Contract size might have number of contracts you would have obtained directly. But in this question he didn't ask that much directly. Okay, transaction is on dollars, invoice is in dollars, but the futures and options transaction is quoted in pounds. So everything first we need to convert into pounds. Lastly we will again reconvert back to dollars and we will tell amounts. Okay, now so number of contracts is how much? 17.17. But 17.17 contracts is possible or not possible? Not possible. So how many contracts will be there? 17 contracts only is possible. 17.17 is not possible. Okay, now listen. Hedge procedure. Hedge procedure. Okay, hedge procedure. How this hedge procedure will continue? Let us see. See here everyone. First, number of contracts 17. Number of pounds per contract 12,500. Number of pounds covered 12,500 into 17. Pounds 2,12,500. 2,12,500. Okay. Now answer my question clearly. 364,897 is the total invoice. Okay. In this total invoice of 364,897, I converted using a spot rate of 1.7. Therefore, they got converted into pounds 214,645. In this 214,645, only 2,14,645, only 2,12,500 only could be covered because of standardized lot size problem. How much is the standardized lot size? 12,500. Means in 214,645, 212,500 are only covered in the hedging of 17 contracts. Means 0.17 contracts is still uncovered or not? How much it is? So this 2,12,500 rupees, 2,12,500 rupees into 1.7 means in dollars you have to pay 361,250. In pounds terms you will pay 2,12,500. Means, I repeat once again, I entered into, sir, we are UK. Payment should be made in dollars. Means of always what we should tell in the home currency how much is my outflow I should tell. So in home currency how much is the pound outflow I should tell. How much is the pound outflow? 2,12,500. Is this the final outflow? No. Do you know why? Reason is very clear. 2,12,500, okay, 2,12,500 covers only rounded off 17 contracts. What is my total invoice value? 364,897. In pound terms, how much is the invoice value? 214,645. At what rate you converted? 1.7. Why you converted at 1.7? We are using which hedging strategy? Options. We are using options. In fish market, fish prices will be quoted. In options market, options prices only will be quoted. At 1.7 option price, we converted which option? Pound put option we converted. Okay. So because we buy dollar means we sell pounds, because trading is made in pounds. So everything we convert into pound terms now. Okay. So in pounds, 1.7 dollar 1.7 terms, so we converted it. It became 214,645 pounds. But 214,645 pounds you can't cover using the options market because standardized lot size problem is there. So how many pounds will be covered by one contract? 12,500. Okay, 12,500 means how many contracts will be there? 17.17 contracts will be there, rounded off to 17 contracts. Rounded off to 17 contracts. Okay, 17 contracts will cover 2,12,500 only. 2,12,500 only. Okay, so uncovered portion, pounds 2,14,645 minus pounds 2,12,500. 214,645 minus 212,500, that equal to pounds 2145. Pounds 2145. Pounds 2145 worth is uncovered, covered, uncovered. This uncovered portion we need to hedge using forward. We have to hedge using forward. Okay, very important adjustment. I repeat. How much is my total exposure in pounds? 214,645. Can total 214,645 can be covered in options market? No. Reason is options there is a standardized lot size. How much is the standard lot size? Pounds 12,500. That means I can cover only rounded off 17 contracts. Okay, rounded off 17 contracts. How many contracts are there? 17 contracts means it will cover 2,12,500. Means how much uncovered portion is there? Pounds 2145. Pounds 2145. Very important adjustment now we are going to make. How you got this 2145? We reduced 2,12,500 from 214,645. Okay, how the 214,645 you got? We divided 364,897 by 1.70. Okay, that means really your invoice is in pounds, invoice is in dollars, invoice is in dollars. That means I want to know how much dollar value of invoice is for this 2145. So dollar worth of uncovered portion. At what rate you converted it? 1.7. So pounds 2145 into 1.7. 2145 into 1.7. How much? That equal to $3647. $3647. This much amount I need to cover using the forward. I need to cover using what rates? Forward. Okay. See the question and tell what is the forward rate given. This is the forward rate. tell me. We have to enter into forward contract, means we need to buy dollar by selling the pounds. We are selling the pounds, bank has to buy the pounds, bank buy the pounds at lower rate will be the bid rate. So bid of dollar by pound 6 months forward, 1 pound equal to dollar 1.5455. How many dollars we need to cover? 3,467. Now tell me how many pounds? 3647. Sorry. 3647 divided by 1.5455 means how much? 2360. 2360. 2360. What is 2360? 2360 pounds you need to spend. If I would have covered everything in options, I would have spent only 2145. Since that portion of 2145 can't cover using the forward or using the options, again we have taken back to the normal and we are converting that using the forward market. I need to spend how much? 2360. 2360. Okay, 2360. Next, there will be upfront premium I need to pay. There is a upfront premium I need to pay. How much is the put premium? 0.096. 0.096. Okay, dollars 0.096. See here, 1 pound equal to dollar 0.096. 0.096. Okay, how many pounds worth we need to have a value? Simply to tell, 1 pound equal to 0.096 US dollar. 0.096. Okay, now you should only tell I need to convert how much worth. Simply to tell, okay, simply to tell, options la how much is only covered? 212,500 is only covered in the options market. I didn't cover entire invoice value worth of 214,645 in pound terms. I didn't convert. I converted only how much worth? 212,500 only I have converted. Therefore, for 212,500, how many dollars I need to spend? 0.096 into 212,500 means how much? Dollar 20,400 put premium you need to pay. Okay, listen carefully. I am from UK. I need to pay the put premium in US dollars. Means again same concept, but premium will be paid at the spot itself. You will pay premium, upfront premium. Okay, not on 6 months after you will not pay. Spot learning will pay. Means spot rate will apply. You have to buy $20,400 and pay. Quotation is given in pounds. So we have to buy the pounds, buy the dollars by selling the pounds. Bank has to buy, bank buys at a lower rate shall be the bid rate. So bid of dollar by pound spot. Okay, bid of dollar by pound spot. Okay, 1.5617. 5617. How many dollars we are having in the contract? 20,400. Means how many pounds? Pounds. 20,400 divided by 1.5617. 13,063. 13,063. This is the third cost. This is the cost 2. Okay, this is the cost 1. So cost 1 is how much? Options created contracts la 212,500 means I will enter into a pound put option. 212,500 I will pay. Okay, in the pound put option. Using that I will pay. But uncovered portion we taken back. Sir, this is a forward, na sir. This is not options. Don't misinterpret. Why you have entered into forward contract? Because of inefficiency of options hedging you have done this. Therefore this is also cost of options hedging only. That means if options would have hedged everything, I wouldn't have got this cost. Just because of the reason that the hedge is inefficient in options, we are entering into another contract to cover the balance uncovered portion. Therefore we will treat this also as a cost of options only. So 3 costs. 2,12,500 plus 2360 plus plus 13,063. So the total cost as per currency options is pounds 2,27,923. 2,27,923. Exactly same answer will come also for the institute. Okay, this is how you need to do this problem. Okay, sir, listen to one or two times by going back. One or two times if you listen, then only you can really get the knack over what is this concept all about. Then you practice one or two times, never you again commit the mistakes in this regard. Okay, I will explain one last time before you copy. See here, we are having a invoice in dollars, but the entire quotations are given in the terms of pounds. Pound quotations are given. Transaction is happening in dollars, quotations are traded in pounds. Therefore I was cornered, I have to do everything in the pound format. So I want to enter into options market. I want to enter into what market, sir? Options market. Okay, in the options market, currencies will get traded or not? Yes, they will get traded. Which currency is traded? Pound is traded. So everything I need to express in pound terminology. So invoice value is 364,897. Okay, 364,897 is the invoice value in dollars. But the entire quotations are given in pound. I converted everything into pound format. So when converting, we are using options market. Option strike rate you need to use. So these many pounds you need to spend. But the problem is there is a standardized lot, 12,500, because of which I can enter only into 17 contracts. 17 contracts will cover only 2,12,500. Means how much uncovered portion is there? 2145. That I can't cover using options. Then what to do? You take back using that 1.7 and calculate real invoice value of uncovered portion, convert that and cover that using the forward rate. Forward. Upfront premium we need to pay. Okay, that premium will be paid at the spot itself. Okay, spot la premium this much you need to pay. Means use the spot bid rate. This is the amount. So total cost of total cost of the currency options is 227,923. Now compare. If you go by this one 236, this is 236,510. This is 227,923 only. Lot of difference is there. So go by currency options. Okay, please copy down this. Completed. Next one. So question number 8. XYZ, an Indian firm, will need to pay Japanese yen 5 lakh on 30th June. In order to hedge the risk involved in foreign currency transaction, the firm is considering two alternative methods: forward cover and currency option contract. Indian firm has to pay in yens 5 lakh on 30th June. On 1st April, following quotations are made available: spot and 3 months forward. These are the spot rates. This is the forward rate. Prices of currency on purchase are as follows. Okay, strike price 1 rupee equal to 1 rupee equal to 1 rupee equal to. So what is the commodity that is getting traded? Rupee. So everything you need to understand from the rupee point of view. For excess or balance of Japanese yen, firm would use the forward rate as a future spot rate. Means what? Same. Exactly contract size, if it is not sufficient, use the forward rate. You are required to recommend cheaper hedging alternative for XYZ. This is the question that is being asked. Okay. First, read the question properly before we go on with the solution. Read it. Okay. Completed. Okay. First, let us go by forward hedging. Okay. First, tell me, everything is given in rupee terms or yens terms or rupee terms. Tell me. We have Indian firm will need to pay in yens. So we need to buy the yens by selling rupee. Because quotation is given in rupee, na? Tell everything from the rupee point of view. We have to pay in yens. Means we need to buy yens and pay. Buying yen means rupee sell. So we are selling rupee. Bank has to buy rupee. Bank buys at a lower rate. Lower rate shall be the bid rate. Okay. So write down. Question number 8. Question number 8. First option. Forward contract. Forward contract. Okay. Tell me now. Forward contract. First, bid of yen by rupee 3 months forward. 1 rupee equal to bid we need 3 months forward. 9726 yens. So how many yens you need to pay? Question la 5 lakh. 5 lakhs divided by 1.9726 means it is 253 473. 253 473. Okay, first copy down up to here. Okay, next. Second, currency options. Okay, first same thing, write down one by one. Invoice value yens 5 lakh. First, next, required trade. Tell me, we need to enter into, we need to pay in yens. Means we need a guaranteed buying price for yen. Means we need to enter into yen call option. But yens route they have given a rupees are rupees. So we have to buy yens by selling rupee. Selling rupee means which option we need? Option to sell we need on rupee. Means which option? Put option. So rupee put option. Okay, next. So strike price on rupee put. What is the strike price? Put option la strike price. Okay, put option and call option strike price same. Premium will change. Okay, 2.125. 2.125. Okay. 1 rupee equal to yens 2.125. We need 5 lakh yens. So 5 lakh divided by 2.125. 5 lakh divided by 2.125. 2.125. Okay. So rupee value equal to rupees 2,35,294. 2,35,294. Okay, na? Okay. First up to here, understood the point, everyone? Okay. This is the value. Problem is, in this question, they didn't give any standardized lot size. Directly you have to take. Number 5. Premium. Okay, number 5. Premium. So how much premium we need to pay? See here. 1 rupee equal to yens 0.098. 0.098. Put option premium 0.098. How many rupees contract we need to enter? Rupees 235 294 means how many yens? Yens, or I will write here yens 235 294 into 0.098 means 23,059 yens. Okay, this premium we need to pay when at spot we need to pay. Okay, spot rate la which rates are bid rate, because we need to buy pounds by selling rupee. So bid of n by rupee spot. What is the bid of n by rupee spot? 1.9516. 9516. 1 rupee equal to yens 1.9516. I need for yens 23,059. So 23,059 divided by 1.9516. How much? 11,000. Here I will write 11,815. So what is the total cost? 235 294 plus 11,815. 247,109. 247,109. If you go by that, it is 253,473. If you go by the option, it is 247,109. So options is recommended. Copy the answer. You can also check the study material answers exactly. 1 rupee also we will not go out. Okay, perfectly if you do problem, exact suggested answer you will get. But what is the new point you learned here? Standard lot size not given. Directly we can do. Over. That's all. Okay. So this question actually is now it is taken out from the institute material. This was actually one of the old RTP question. I kept with an intention that there is a new point inside. But the problem is straddle strategy, all these things are removed from the syllabus. Therefore, that doesn't have any meaning today. Okay, from the syllabus point of view. Okay, I will just normally put a answer for this. Just you see and leave. But originally doesn't have any sense to make. With this, we have completed currency options and currency futures. With this, derivatives over. So these are all the important areas that we need to discuss. Next, on a summary basis, I will be covering out the bond valuation and leftover concepts in portfolio. One or two areas are there, those summary areas. And mergers loss, people are asking, sir, this first some problems are there. Since answers are there in study material and mergers chapter is easy, I didn't take so seriously, but still, anyway, consistently students are requesting me also in the group. I will definitely do that. Syllabus per se, main concepts will be over from the fast track point of view. Okay, mainly from the bonds point of view, interest rate risk management I will mention, I will tell. When time permits, just put your time of around 2-3 hours. Bond valuation concept wise I will cover. Okay, and interest rate risk management also I will merge with bond valuation chapter only. And portfolio sharp model, one model. Mergers 1 or 2 balance 6-7 problems are there, those I will do. Okay, as a syllabus point of view, these are the important areas to cover from the fast track issues. Okay, thank you.